Let's go right now into our first story here. Fed wage growth is too high for our 2% inflation target. We need to talk about what happened with the latest Fed comments today from the Indianapolis Fed. So here, according to what he said, a couple years ago, I said and my colleagues said some of these factors look like they are temporary or transitory. Supply chains are going to get sorted out. Well, yeah, that's kind of sorted out, but we're still having some issues there. So maybe we do not need to overreact. Well, that didn't turn out too bad for them. Remember the transitory inflation, everyone? It turns out inflation's a lot longer than they thought, and they've been slow to react. Well, it took a lot longer than we expected. Yes, it did. And now you are seeing wages climbing, and wages are climbing, trying to catch up to that inflation rather than leading the inflation. But now wage growth is at a level that is actually too high to be consistent with our 2% inflation target. So this is something big, everyone. A lot of people thought first inflation was transitory. Then they thought it peaked. Then we had what Jerome Powell saying, disinflation. Well, now we got new data that shows inflation is skyrocketing again. Got even more newer data to say that wages are now climbing, and that's going to keep inflation elevated, because if prices go up and then people's wages go up to meet those prices, then they can somewhat afford it. Now, we all know wages aren't keeping up with real inflation, and real inflation is much higher. But if inflations do keep going up, then that can create what the Federal Reserve fears is a wage price spiral. So let's go into some other things that they're very worried about in the economy and why things just may not change overnight like they're hoping about. So traditional tools are not working. This is a very complicated economic environment that we're in terms of our ability to analyze it using the traditional analytical tools that we have. So we have got a very complicated economy since COVID. We've had huge supply chain issues. We've had worker shortages. We've had 0% interest rates. Now we've got interest rates skyrocketing. We've got labor shortages. And also what we're going to go over in a moment is huge demographic shifts. We had the baby boomers. They were a huge part of the workforce, but now a lot of them are retiring, and millennials aren't having many kids there now. So there's going to be a huge supply of workers coming over the next couple of decades. So getting inflation down, listen to this, more important than avoiding a recession. So you have the Federal Reserve saying now that getting inflation down is more important than avoiding a recession. So they're saying a recession is going to come, and even if a recession comes, but inflation is still high, they're still going to keep hiking. What you had is a lot of people saying, or a lot of the markets are hoping for, is the recession will come, because the stock market is not the economy. The stock market actually wants a recession to come. They want unemployment rate to go up. They don't want people to get a pay rise. They want companies to announce more layoffs because then that helps pump their stocks. All they care about is 0% interest rates, cheap money, and money printing to keep their stocks inflated. What I think is going to be a rude shock for them is when we do get that bad news that recession's coming, we're going to be facing stagflation, where inflation is still very, very high, and the Federal Reserve has to keep on lifting interest rates, and they're not going to get those rate cuts that they've been pricing into the markets, and that's why we're still going to see more pain for the stock market coming ahead. Now, also, they're finally admitting it. Monetary policy cannot address structural issues. So, for example, they can't print oil, they can't print food, they can't buy better supply chains, okay? There's simple structural issues that the Federal Reserve can't do anything about. All they can do is crush demand. So monetary policy can try bringing the economy into balance in the short run, but the long run, structural issues, monetary policy cannot do anything about. So again, they can't print oil, they can't print food, okay? They can't give UBI yet unless they bring their CBDCs. So there's a lot of things the Federal Reserve has no control over, and that's why interest rates are still going to have to keep going up. Now, also, like I was talking about, demographic labor challenges. All advanced economies around the world are facing labor challenges because advanced economies are having fewer kids than prior generation, and those fewer workers to produce things, and there are fewer workers to buy things in the future. So this is another massive, massive thing that I don't see many market commentators talking about right now, is this massive demographic shift. The baby boomers, they're the wealthiest generation right now. They're going to be retiring. They're probably going to be selling stocks. I'll get into later how there's a huge rush of cash into bonds right now with yields over 5%. And simply, there's just not going to be enough young people to fill these job positions. And that means there's going to be this pressure on wages, of course, unless they, open the borders and just let immigration run rampant, which is actually what they want, and we'll get into in a moment. So immigration, they say, is the only answer. So Japan is trying to pay their workers to have more babies. It doesn't work. The only answer they say is immigration. This is a structural issue that we as a country have to get our head around. Sensible immigration policy that meets the needs of our economy. He said he's not making a political statement. I've met Republicans and Democrat leaders who all understand this. It's simply math. So he is right. Simple math there. If you're not having more babies and all the baby boomers are retiring, there's not going to be enough workers and they're going to need immigration. Now, hopefully they can have legal immigration, not illegal immigration like what we're seeing at the border right now with it being completely overrun. Hopefully they do more targeted legal skilled migration to fill these specific industries or the specific skill gaps and fill these jobs, not just, open the floodgates and let illegal immigrants in. Also, what that does is that makes wages lower, but it makes house prices higher because there's already housing shortage. If they create immigration, and then there's going to be even more demand for housing, more demand for food, more demand for gasoline. So what it does is it keep wages low, but the costs even higher. March rate hike and dot plot. So it's going to be very interesting to see what the Fed does during their March meeting to say where interest rates are going to go. So there's a lot of attention on March. Is it going to be 25 basis points or is it going to be 50? I'm open-minded at this point about whether it's 25 or 50 basis points. To me, what's more important is whether it's 25 or 50 is what we signal in what we call the dot plot. Now, that's exactly right, everyone. A lot of people are figuring out, should they do 25? Should they do 50? Or they're really worrying, okay, if they do 50, that's really bearish. And yes, that is in the short term. But really what we need to pay attention to is where are they actually going to end? They could do 1% now. And yes, it'll be bad now, but if they only lift interest rates to 5.75%, yes, they'll be bad. But what would be even worse if they just do 25 basis point hikes, but inflation gets out of control and they actually have to lift interest rates to 8%. It's not about how fast we get there. Yes, that'll create volatility in the markets, but it's more about where we end up. So in December, when he jotted down his dot plots, he said, I jotted down that I thought we would get rates up to 5.4%. That's more than the markets are thinking now. And then told them would be there for an extended period of time. And he said he was one of the more hawkish. So this is a person on the Fed board here. He was the more hawkish among his colleagues. Given the data we have gotten in the last month, which has been a very strong jobs report, higher inflation than we expected, and these are concerning data points suggesting that we are not making progress as quickly as we'd like at this point, and I've not decided what my dot is going to look like, but I lean towards continuing raising rates further, and I'll continue to push my policy path. So guys, what this means is there's going to be much more rate hikes than the markets are pricing in. And all these people saying, well, don't worry, when the recession comes, the Fed's going to pivot. No, I think what we're going to be facing is stagflation, where the unemployment rate ticks up, inflation stays high, and also the market is not pricing in a recession. They're pricing in this soft landing or no landing. Well, I think we're going to have severe pain, but the Federal Reserve is going to have to keep hiking, and this is something nobody's prepared for. So what he continues to say here, if the Fed was not so hell-bent on producing this 2% inflation while not understanding what it really is, or the nature of what they seek, perhaps more people would want to have kids. So this is a commentator saying here, well, the reason why people can't have kids is because the cost of living is so high and inflation is much higher than their 2% target. The same applies to government control over our lives. So that's another thing there, people worried about the government, people worried about losing their freedoms, people worried about the world right now with the geopolitical tensions. Maybe they're worried about bringing kids into a world that's very uncertain right now. And so they need to fix some of these issues, the geopolitical issues, and also the cost of living crisis. Otherwise, you're going to have more and more families that cannot afford to have kids, or if they do, it's going to be very tough. Now, another story here. A year later, and the Fed still has a long way to go to fight against inflation. So that's right, everyone. It's been over a year. People thought, the Fed will do some hikes. It'll drop straight back down, but no, that's not happening. And now we have here the BIS. This is the Bank of International Settlements. This is the central bank for the central bank. And they're very, very worried right now that central banks may have declared victory too early, like Jerome Powell said, by saying, we've got disinflation now, and then next month we got literally sky high inflation. So he's saying here, central banks need to get the job done when it comes to getting inflation back under control. The Bank of International Settlements has said, urging them to avoid the mistakes of the 1970s by declaring victory too early. So that's exactly right, everyone. What people may think is, okay, inflation, prices just go straight up in a line. Where no, it's actually very volatile. You may have prices going up for a bit, then they'll dip. Then people will think, okay, we've got disinflation, we'll start lowering rates. Well, then we only get inflation surge again, because you're comparing prices with month over month. If prices surge in a month, then the next month they may stay flat. That doesn't mean we have disinflation. That just means prices aren't going up at the same rate they did the previous month. And also Michael Burry warned about this in one of his Twitter posts last month, saying, don't declare a victory on inflation yet, because inflation can be very, very volatile. So he also go on to say here, central banks have been very, very clear that at this stage, the most important aspect is to get the job done. The head of BIS monetary policy and economic department said. List of countries where they've lifted interest rates. Right now, the US is number one. They've done 450 basis point hikes. Well, they've lifted their rate to 4.75. Followed by Canada. They're now got rates of 4.5, New Zealand 4.25, UK, and look at Australia. Australia's being a bit of a wimp there. We've only lifted rates to 3.35%, and a lot of people in Australia, thinking that's it, not going to have any more rate hikes. Well, I think a rude shock is going to come for a lot of Australians, that we have to follow what all the other central banks do. Otherwise, our currency get absolutely decimated, and we'll absolutely see the Australian dollar crash. And if the Australian dollar crashes, well, then that makes everything we import, which we import a lot, much, much more expensive. But to wrap this segment up, we're going to have interest rates higher for longer. Inflation's getting much, much worse. The markets haven't priced in what if interest rates go to 6 or 7%, and they also haven't priced in that when we do enter recession, the Federal Reserve's not going to pivot. They're going to keep lifting rates if inflation stays high for longer.